Hey guys, welcome back to another video. Today we're talking about my price forecast for 2025 on things like gold, the dollar, stocks, and so much more. As we get into this video, I just want to go ahead and break it out for you into three different main pieces. First, I'm going to recap my 2024 predictions so you can see how on it or off I was about certain things. And then we'll go into my general perspective for the year of 2025, my overall macro analysis. And then part 3 of this video will actually be my forecasts price-wise for a long list of different assets. You can see a preview of what that Excel spreadsheet will look like. So on this video, as you're going through, you'll see it's a really long video, but you can skip ahead to certain chapters if you're not interested in watching the full length of this video. So I quickly wanted to go back and take a look at how some of my previous year forecasts went in the financial markets. I made this video last year, and we're going to go back and hold myself accountable on those calls that I made. Starting with the S&P 500, here's what I had to say back in 2024's beginning of the year forecast video. If you're looking at the S&P 500, we had a huge breakout this year. It was really, really strong, but I think it is due for a healthy pullback. And so when I say that, again, markets are so optimistic off of rate cuts, and I do think that they're valid in doing so, but I think that there's room to see some pullbacks. We saw a bit of a breakout here towards the end of the last trading day of 2023, and I think that this has room to potentially pull back further. Same thing with the NASDAQ, same thing with the Dow. So obviously you could see I was a little bit hesitant on the S&P 500 at the beginning of last year, and kind of have remained so for some time. That being said, I have been very bullish specific areas of the market in 2024. A lot of the gains that I made were actually being long the NASDAQ, and the S&P 500 forecast that I had for last year was bullish, but looking for pullbacks. So if we actually go back just really quickly to January of 2024, you can actually see we pretty much had a straight shot move to the upside, and then we came down. Now, up next, I'll show you what I had to say about the VIX during 2024. With the VIX being so low, I think that there will be something that comes along, there always is, that ticks the VIX back up. Now, I'm not betting on the VIX, but I'm saying I think that there will be something that does that, and that will likely give us the pullback that we need in stocks. A little bit of fear is okay to have in the market. You just don't want to have everybody on the same side of the bench, if you know what I mean. So I mentioned in the beginning of 2024 that things were a little bit too cool, calm, and collected for my taste, and I was waiting for some sort of fear event to happen in 2024 to trigger some larger sell-offs in the market. And that actually, is not a crazy forecast to make, because most years you do get some spikes in volatility, but we had some of the biggest spikes in volatility actually in stock market history back in that August carry trade fear moment. August 5th, the VIX jumped to an all-time high just briefly. And so those were actually some of the best opportunities in my trading right around the election, the August 5th situation, earlier in the year. Those environments were some of the best dip buying opportunities and some of the biggest gains that I made of the years. So I am very bullish on the Russell. Take a look at the weekly chart here. This is IWM. And what we can see here is that on a weekly scale, we've had a significant breakout here. And I think that the Russell has really underperformed the other market indices and has room to go higher. So I am bullish Russell. I will probably be selling puts and selling covered calls in the coming year. And here's a not so great call out that I made last year. I said I liked the Russell, and the Russell absolutely underperformed the rest of the market this year. You can see it was up only about 10 or 11% for the year, and that's compared to the stock market, the S&P 500, the NASDAQ, which were up 25+% overall. Next up, I'll show you a quick clip of my forecast for the dollar, euro dollar, pound dollar, just most dollar crosses that I made at the beginning of 2024. I expect for the euro, I'm pretty much neutral on the euro going into the new year. Now, of course, this could change throughout the year as we get developments and things like that. But the euro and the pound USD, I think, of course, price action wise, you could get movements that cause, nice trends to occur. But overall, I don't have a strong winner in this camp. I think that the dollar will remain weak, but I don't necessarily think it's going to absolutely crash. And so for the most part, I think there's kind of a neutral read. And what you can see is, for the most part, I was right for most of the year until this very last end of the year sprint for the dollar index. I mentioned being pretty neutral on the dollar going into this year, and that really was mostly correct for most of this year. We saw the dollar go up, then have a big sell-off, and then right here at the end of the year, though, the dollar has had a really impressive move. Dollar's up about 7%, the dollar index, which is actually a pretty strong end of the year close. I would not have guessed that we would have such a violent move to the upside here towards the end of the year, but hey, that's markets. They're very difficult to predict, and that's why I'm doing these videos, to hold myself accountable. Another thing I was pretty wrong on was the dollar yen. Check this out. The JPY could strengthen because the Bank of Japan is talking about rate hikes. They're talking about getting their interest rate back into, decisively positive territory. Meanwhile, you have the US talking about rate cuts. And as we know with currencies and bonds, rates have a huge impact on what the market does. So I'm actually looking for more bearish setups on dollar yen as we go into 2024. So going into 2024, I thought that the yen would cool off. We had a huge rip through 2023 on the dollar yen to the upside. I actually thought that the yen would continue to strengthen and that we would see the yen strengthen against the dollar. We actually saw the opposite, a huge move to the upside for the dollar yen. That being said, we did see the yen strength come in, but it was much later than when I actually called for that. So we saw a huge strength in the yen that came later. But again, there was a long period of time where the dollar just continued to dominate. And then towards the end of this year, we've seen a really big move yet again to the downside for the Japanese yen, dollar yen moving higher. I think gold is bullish next year. And I think that it continues to be bullish as the market may swing back. A little bit of concern comes back into the market and we don't just have pure euphoria all year. Like I said, I will be bullish stocks and gold still going into the new year. Last year, I also made a very strong prediction for gold, and that was actually probably one of my best call outs for the year. A lot of the gains that I made in my account in 2024 were largely from the bullish prediction that I made for gold. I basically figured that most central banks would be cutting rates, and that absolutely did come true. And while that didn't necessarily help my Russell trade as much as I would have liked, it really helped my bullish thesis on gold. And that definitely was one of the biggest and best calls that I made in 2024. That being said, gold went way further than I thought it would. And that just goes to show, again, markets are very difficult to predict. And what I found is that generally speaking, direction is a little bit easier to call than magnitude even, at least in my experience here. A lot of times I can get the direction right, but the magnitude of how far something can go is what is tricky. And the timing of that is also inherently very tricky. Okay, guys, so now that we've gotten through going back over 2024, I want to go ahead and now take a little bit of a look at some of the contributing factors to why I came up with the 2025 forecasts that I did. So I'm going to show you those forecasts towards the later half of the video. If you would like to skip ahead to those, feel free. We'll make sure to chapter this video for you to easily find it. But this portion of the video, stage 2, will be kind of going through the analysis component of the perspective I have for markets going into 2025. I also want to reiterate as we get into the forecasting part of this video, as you just saw, forecasting is very difficult in markets and things can change throughout the year. Right now, I feel a certain way about markets based on what we're seeing, but those things could change. That's why these videos are always a little bit tongue-in-cheek because, again, markets are a very hard thing to predict and things can come along. New wars can start, a recession could stew up, right? Things can happen. So that being said, let's jump into the forecast component of this video for 2025. So I want to start out and just kind of say that the best way to outline how I feel about the markets going into 2025 is a continued risk on theme like we saw in 2024. Now I'll get into everything like specifics like gold and the Russell and NASDAQ and stuff as we get into this, but let's talk a little bit about where we are economically. And I'm going to be focusing a lot on the US data here, so bear with me. GDP growth for the US has been very upbeat in 2024. And going into 2025, I expect the most likely scenario is for that to continue. Typically, good economic activity stews, a consumer feeling better because they're getting jobs and doing well. And that in turn turns into more economic activity that is good. I would say that the path of least resistance for an economy that seems to be doing quite well is for it to continue to do quite well. Unless something comes along to disrupt this cycle, I generally think that the strong economic growth that we're seeing in the United States, which is, by the way, even better than most of our allies and other nations out there, the U.S. is really outperforming in terms of economic growth. Take, for example, European GDP growth, which is much more modest, Japanese GDP growth, which is, again, all over the place. And it just kind of brings me back to the strong kind of overall outperformance that we're seeing from the US. But it doesn't stop there. We could take a look at things like services PMIs, which have been above 50. These readings are, generally speaking, pretty strong. Now, services PMIs is a services specific, so the services component of our economy, which is a big part of the US economy. This is a purchasing managers index data. Now, what that means is that basically a bunch of purchasing managers or people who make decisions at big companies in the services component of our economy get surveyed on how they're feeling about hiring, how they're feeling about spending, how they're seeing orders come into their businesses. And so far, sentiment still is improving. It looks very strong. And again, going back to that cycle of strong economic expectations turn into hiring and orders, and that turns into more economic activity. Most of the time, that is the case. So we're seeing some upbeat strength in the services component. And I got to say that the handoff going into 2025 is a pretty strong one. Even manufacturing PMI, which is a smaller component of the US economy, seems to have a little bit of an uplift. And I do just wonder, not to get political, but again, there's a lot of emphasis on potential more manufacturing coming back to the US with some of the tariffs that Donald Trump is expected to potentially, put on the global trade situation. Maybe manufacturing is looking a little bit upbeat compared to recent times from that reason. I don't know. We'll have to see. Here's a look at the consumer. We see retail sales actually beating expectations for the last 3 readings, actually 4 readings, actually 5 readings in a row. So retail sales looking really strong overall. Now, what are retail sales? Well, this is, again, exactly what the name entails. It's what the consumers out there spending. How much are they, how much consumer spending is going on? Are people out there spending a lot of money or not? And when there is good consumer spending, that is, again, a positive thing for the economy. Let's now take a look at jobs numbers, which have also been pretty strong compared to expectations. You can see the red dots are expectations, and most of our recent readings have actually been beating expectations for jobs growth. People are getting hired in the United States overall, which is a solid thing. And when we take a look at the overall unemployment rate in the United States, you can see that it is rising. However, unemployment rate is not at a critical or really scary level. The long-term average, as I mentioned often on my channel, is 5.7% unemployment rate in the United States. And with that number not necessarily getting too close to that at this point, I'm not too worried about the labor market for now. Now, that could change. If you get an uptick in inflation and layoffs start to pick up, then yes, we may need to look at this a little closer. But as a trader, I'm looking at what I can see right now, which is, again, overall unemployment rate is not super threatening to the story for continued economic growth. Here's a look at unemployment claims, and we can see that this number is also not, majorly ticking higher. If that was the case, I'd be a little bit more worried about the unemployment rate potentially going higher. Job openings in the United States have been trending lower, but we can see that they're actually kind of coming back to where we were pre-pandemic. So, we're seeing job openings decline here post all this inflation and, higher interest rates. That is having an effect, it seems, on job openings, but it's not like we're way down here, right? So we're not at critical levels at this point just yet. As long as, we do see the Fed cut rates at some point this year, which is a big if that is the case, then you may see this number kind of hopefully go sideways or even start to go back up. Wage growth in the United States at about 4% does outpace inflation, which is potentially why also consumers are feeling a little bit better than they were a couple years ago. Here's a look at inflation, which has fallen pretty far, gone sideways, fallen again, and now the question is this upticking? That would be one of the big disruptors, which could cause a larger pullback in the stock market this year if we're going to have one. In my opinion, a big catalyst for that would be an uptick in inflation, a rise in yields, and a decreased expectation that the Fed is going to cut rates. Next up, we'll take a look at some positioning in terms of both the commitment of traders, which is institutional positioning, as well as retail. So right now, what we can see here is that gold is still a institutional favorite. Oil also, silver as well, the Nikkei and the NASDAQ. These are some of our highest proportionally longed instruments on the list. If we take a look at the other side, you've got the Canadian dollar, the Kiwi dollar, the Swiss franc, the Australian dollar, and surprisingly here, actually treasuries, also a very short proportional position according to the Commitment of Traders report. Now, what you're looking at, again, is one side of things, and for a longer term perspective, this is actually quite helpful to look at. This is where big money seems to be parked, most proportionally long or short. And of course, when you do, if you're an EdgeFinder user, you can of course look at this on a week-to-week basis. But for the purpose of this video, it's actually a little bit more important in my view to look at the long-term positioning and percentage-wise. But I'm going to continue to watch this thing week to week, as I always do, to see where the latest money moves are happening. And what we can also see is that with the COT data history, which is a new feature that we added to our software recently, we can actually take a look at like things like the dollar over time and see where they're trending. This yellow line is the long percentage over time. And as that number is going higher or lower, that's showing you whether or not over time, week to week, whether institutional money is buying or selling. And of course, if you have the EdgeFinder, you can take your time to go through all of this. You want to look at gold, you want to look at NASDAQ, Nikkei, etc. And if you made it this far in the video, I did want to just pause and say Happy New Year to you. Thank you very much for supporting my content just by watching, liking the video, thumbs up, all that stuff does really help just with the YouTube algorithm. I also wanted to mention that if you're somebody who is serious about getting some more economic data and Commitment of Traders data, retail sentiment data, all this stuff into your tools, we're going to do a New Year's sale for a very brief amount of time. It is kind of a secret sale. So if that is something that you're interested in finding more information about, the first link in the description will allow you to chat directly with our support team behind this software. If you'd like to get access for a very low cost, our New Year sale is now available. Click the first link in the description down below and chat directly with our support team for some information. Now, if we take a look at some retail sentiment, what we can see is retail traders are still very much betting against the dollar going into the new year. Now, they've been on the wrong side of this trade for many months now. If we take a quick look at some of these currency pairs, you'll see that the retail trader out there is really getting hurt by some of these currency trends for the currency traders out there. Here's a look at the euro dollar, and you can see again, retail traders have been very long and adding longs for months now on this currency pair, and it just continues to melt lower and lower. Same thing with the Kiwi dollar and the Australian dollar and well, pretty much everything against the dollar right now. If you're betting against the dollar, which seems to be the retail trend, that's been a really painful one. The question is, going into 2025, is this going to stay the case? Well, right now, I would generally say that I think that dollar strength is set to continue. Unless you have something that comes along and disrupts it, the US economic outperformance still makes the other currencies look less attractive to me, especially if the Fed is talking about not cutting rates as many times in 2025. That is definitely a concern for foreign currency to the US dollar, right? The US dollar has the potential just to continue to outperform, in my opinion, until something seriously changes. Perhaps that would be US labor market cracking. Something that gets the Fed to cut rates more aggressively would be the only thing right now that I see that could really take the dollar off of its throne. In 2024, I used the put-call ratio quite a bit to help me time better entries for my indices plays. I waited for opportunities like the one what we saw right before the election, these big spikes when people went crazy buying puts. And in a bull market, that signal can be a very, very good short-term buy the dip opportunity that I'll be looking out for going into 2025 as well. And while we're talking about stock market indices, I actually love what I'm seeing here in the AAII Investor Sentiment Survey, which is showing traders are getting more nervous about the outlook for the stock market. In fact, we swung to our highest level of bearishness that we've seen in several weeks and the lowest amount of bullishness that we've seen in several weeks as well. I love seeing sentiment start to get scared, and it seems like many people are scared for 2025, which does kind of make sense considering we've had 2 back-to-back years of 25 or so % gains in the stock market. So people are a little bit nervous that we're at the top or getting close to a top. And again, the thing about that is it's very hard to predict just how far a bull run is going to go. Right now, conditions look really good. And with sentiment kind of getting scared, that's actually going to keep me on the bullish side of the stock market and risk on instruments just in general. As we take a look at seasonality for the year ahead, I think that this is really interesting. January is actually, historically speaking, not a particularly bullish month, at least in the last 10 years for stocks. A lot of rebalancing goes on. A lot of people are wobbly at the new year. There's usually some selling that happens for tax benefits. A lot of people wait to sell their gains into the new year so they don't have to pay taxes until the following year, right? It makes sense, but that usually can cause some mixed sentiment in January. And in my personal opinion, if you get some dips in January, I am going to be a buyer. So I'm looking at that as an opportunity in the stock market. But then we have most months are expected to be positive. Then you get that kind of lull in the third quarter, September going into October, the fourth quarter. And then there's that usually that strong end of year rally. We did not quite get that in 2024. It was actually kind of a weak month for stocks, but November was very, very good. So I'll, as always, I'll be watching seasonality as a key component to my approach. And as we finish out our analysis with the Edge Finder, I did want to just mention, like I said, I dropped that little hint that you guys can get our New Year's discount. Do not miss that opportunity. The Edge Finder is a very powerful tool for serious traders out there, and it's a one-time cost. So if you'd like to make sure you don't miss that New Year's sale, click the first link in the description to find out more information. One thing that I love about the Edge Finder is that it combines all of the things that we just discussed manually, and it automatically generates scores for all of my favorite assets throughout the week, throughout the month, throughout the year, and it helps me to stay on top of all of that data without having to do all of that analysis every single day. So the Edge Finder kind of is an aggregate tool that looks at a lot of different indicators and generates bullish and bearish readings for me on my favorite charts. It is a very powerful tool, and I do want to just mention that the Edge Finder has been a major contributing factor to what I have been able to do in the markets in the last few years. Speaking of which, here was the final tally up on my performance in 2024. The account is up very nicely since inception in 2020, and I just wanted to show you this because, again, whenever I talk about things that I have for sale, I like to back it up with a proof of concept that I actually trade, that I actually have some performance to back what I sell. So don't miss it. If you're interested in getting access to the Edge Finder, first link in the description and pinned comment down below. Okay, guys, so now we're on to the next part of this video where I'm actually going to get into the forecasts, at least what I have marked on my sheet here for 2025. Now, I do also want to mention that we also have my targets, Frank's targets, Chris Pulver's targets, and Ivan's targets. All four of us, we make up the team at A1 Trading on the trading side. So our trading analysts all put together our own personal targets for each of these things. I'll be sharing theirs in the video, or you can just see them as well. But I'm really going to focus on my personal forecast for everything starting out here. On this far right hand side, by the way, you'll also be able to see our team's average target between the four of us and the percent expected move aggregated from all four of us. So starting out, we're going to take a look at the S&P 500, and I use the symbol SPX 500, which is a CFD version of this. And just so you know, we made these actual forecasts going back in mid-November. So these are already over a month old forecasts, but just keeping them on here. We made this towards the end of the year in 2024, just in preparation. So my target for the S&P 500 is 66.50. That is where I see price potentially going for SPX. So let's take a look at the technical chart. Okay, guys, so I pulled up a chart here of the S&P 500. This is a weekly chart, and what we can see here is that in 2024, we had an insane, really strong upward trend. Now, you might be saying, and it's actually fairly common, we talked about sentiment earlier, sentiment is increasingly a little bit cautious on this market. And I do think that that's actually pretty valid. We've had a really good run in stocks, and it is probably without a doubt, we're going to probably see some volatility next year. The question is, how much, and will it keep us from actually taking out those highs and continuing the rally? In my personal view, I actually think that the S&P 500 is more likely, not certainly, but more likely likely to continue to make a push next year up to that 66.50 target that I have, rather than a major sell-off. Now, a major sell-off could happen. Again, I mentioned this earlier, something could come along to change that. But right now, when we take a look at the technicals, as well as the fundamentals, right? I like the risk-on story right now. I would not be surprised if in 2025, we see a 10, 15, or even a possible 20% pullback in the market. Now, let's put some context in that when we take a look at the S&P. A 10% pullback is down to 54.66. I think if you have a 10% pullback here that's actually happening as we speak, I still think that my target remains intact. However, if we go much more than a 10% pullback, if we start getting into 15 or even a 20% pullback in the S&P 500, which is possible, I will probably have to revise my target. Now, when I make these targets or forecasts, I don't take them incredibly literally and super hardcore. I'm pretty adaptive as a market analyst. I'm constantly watching this stuff. So this is my target right now, given the circumstance that I think we're in. I think personally that dips get bought pretty aggressively in this market, and that if you get a 10% pullback, most likely we see that as a potential, opportunity to continue the story. I actually would love a dip in the S&P 500. And while I do think that the market is a little overbought right now, there's a little bit of froth out there, and that there is room for a pullback. Again, this is a full year's outlook, so I'm still thinking that the bigger picture could be a continuation. That being said, we may not even get that much of a pullback. If we continue to see kind of something like this, then this is a very easily achievable goal. Now, what is this in terms of a percentage form from today? Well, the upside's about 12.7. Let's call it 13% upside. In fact, if we get kind of little closer to 66.50 on my target, it's close enough. That gives us about a 12% upside. I think that that's actually a pretty modest and reasonable expectation. If I think personally, there's a good chance that we see some sort of healthy corrective move before we potentially see the continuation play. So yeah, I think that a 12% upside move in the S&P 500 next year is fairly reasonable given the circumstance that the Fed wants to cut rates. Trump really loves trying to make the stock market go up. It's his own personal scorecard, it seems. And so I do like the upside for the S&P 500 going next year, though I am very aware that there's the possibility that we do see larger scale pullbacks in between. Continuing on with equities, we'll take a look at the NASDAQ. And my target for the NASDAQ is 24,000. And let's take a look at where it's currently sitting. So here's a look at the NASDAQ on a weekly chart. Very similar to the S&P 500. It's had a very excellent year in 2024, though having a little bit of a pullback in December. Again, going back to this concept, I don't think it's too out of the question to potentially see a larger pullback in the NASDAQ as just part of a healthy upward bull trend. That being said, where I just drew the lines for 10 and 15%, it's a little different for the NASDAQ. I think a 13% to a 15% correction in the NASDAQ is very still okay, right? The NASDAQ's just more volatile than the S&P 500, but once you get past the 20% pullback point, it would make it really hard to hit my target of 24,000 for next year. So I'm really okay with the NASDAQ anywhere between a 10 to 20% drop. I actually would love that as an opportunity to be a buyer in the next year. That being said, I'm bullish now. I have positions on now, and if it just continues to rip, then excellent. That being said, let's talk about where that target is. So I mentioned 24,000. So right around this area, that gives us just about a 15% upside move, let's call it, in the year 2025. So to recap, any pullbacks that happen on the NASDAQ, S&P 500, etc., I'm going to be looking at those as opportunities to buy into the NASDAQ at better prices and looking to trend follow this thing until something changes or breaks with the overall risk on story. Next up is the Dow Jones, and the Dow Jones is much more of a defensive kind of index. It's weighted a little differently. It's actually a price weighted index. My target for the Dow Jones is 47,000. Let's take a look at US 30. The Dow Jones has had a little bit more of a pullback here recently, but again, just like the other ones, especially some individual sectors within the Dow Jones, I'm actually looking at this as a possible buy the dip opportunity. A 10% to 15% pullback, somewhere in that range, I think is okay to still hit the potential target next year of 47,000. So from where we currently sit, if we're going to put up our 47K target here, you're talking about, from where we are, about a 10.5% percent gain next year. So in my perspective, again, any larger scale dip that we get from here, in my view, is an opportunity to potentially build a position, especially if we get down to like 41,000. This area looks excellent for an opportunity, in my personal opinion, to build a bigger position, because again, I still think most likely we end the year next year somewhere around that neighborhood of 47K. Now, that being said, this is not a ridiculous return for the S&P 500, NASDAQ, and a US 30. These are actually pretty standard returns. And given the circumstances, I think that you can actually have some really good returns if going into January, we do see a little bit more of a sell-off, because then you're talking about a much steeper percentage gain just waiting on the sidelines. And personally, I have a good bit of cash going into the new year, ready to deploy if we get some larger discounts on stock indices. Next up is the Russell 2000, and I got this wrong last year. I basically thought that the Russell would rally hard last year, and it severely underperformed. So it was one of my worst calls last year, was being long the Russell. Now, that being said, I still made money because the Russell went up, but it certainly did not do as much as I had hoped that it would. So let's talk about it this year. Am I going to double down, or am I going to change course? Well, the answer is I'm kind of going to double down. In fact, I think that the Russell has the potential to outperform this year. Maybe I was a year early with this idea that I had, but let's take a look at the Russell and see what it looks like. So if we take a look at the Russell, you can see it is not as pretty of an index, not as easily uptrending looking as the other ones. But I mentioned that my target here for the Russell is 2,700. So if we mark up 2,700 on this weekly chart, you can see that that is a pretty good distance away. In fact, from where we currently trade, that would give us a 20% upside move, which actually would be phenomenal. That being said, why the Russell and why now? Well, here's the thing. Last year, I was early on this idea that the risk on rally would continue and expand. I mentioned in my 2024 video that I thought the market would broaden out, which means that more things would participate in the rally rather than just the ginormous tech companies that have been leading, and they killed it last year. So I was early on that idea. I still think that if the economy holds up and that if inflation comes down and the Fed cuts rates, the Russell should have a very good 2025. Now, it's a high risk play because the Russell is more volatile than the other indices as well, but I like the risk to reward here, especially with the recent dips. I think people are a little, running back to the Mag 7, the big companies, because they have, obvious earnings growth, and the Fed may or may not cut rates that much next year. I kind of had the tendency to think that the jobs market could cool a little bit, inflation could come down, and especially if oil prices come down, that could give way to more rate cuts, which could severely lift Russell 2000 stocks, which are more held down by higher interest rates. They just borrow more money. There's a lot of, regional banks in here. There's a lot of things that are sensitive to the financing rates that are out there from the Fed. So I think that actually could unwind a little bit next year, and we could see some relief rallies in those areas. So I like the Russell. I'll be looking to buy dips on this one, pullbacks, and kind of holding on to a position if I can, and trading into this one as long as I see momentum continuing to hold up. But on the weekly chart, we actually look decently healthy overall. And if we take a look at the daily chart, we just tested the 100-day moving average. If we go down and test the 200-day moving average, I actually think that is a really good kind of risk to reward setup. And let's just go back, or actually we can just stay here on the daily. The 2,700 mark from the 200-day, let's just say, we tagged that. It's a 24% upside move. So I actually think that there is good upside for the Russell, and I'll be looking to play that in 2025. Next up, we'll talk about Chinese stocks for just a second. The HSI is the Hang Seng Index. Let's take a look. So the Chinese stock market has done absolutely terrible the last few years. And the reason I included this in our watch list for 2025 is because this is a bit of a contrarian play that I think has potential. We've seen in recent months some attempts from the Chinese government to introduce new stimulus to get the Chinese economy off the ground and running again. Chinese economy is massive, it is innovative, and I do think that although, there's the communist stuff, there's the fear of foreign investment leaving China, there's the real estate bubble, there's a lot of reasons to be scared of Chinese stocks. I have a small portion of my portfolio that I'm dedicating to trading this long side for next year. So I actually think that the upside move target that I have on 25,000 would give us some massive upside potential in what is, in my opinion, a very, destroyed stock market that potentially has the chance to turn around. Part of the reason here is that this is a bit of a play on the idea that, again, there's so much bad news for this country's stock market, but it's still the number 2 economy of the world. More and more trade is going towards China in the global situation. And, I generally think that they probably want to participate in all the stock market rallying stuff that we've seen in Western, nations, right? Their Western counterparts have been having massive stock market gains. Japan, India, the US, right? All these other countries are rallying, and meanwhile, China's stock market looks embarrassing. So I think that they're going to make more stimulus attempts. It's a bit of a contrarian play. I could be dead wrong about this, and I'm not putting a huge amount of money on this idea, but if there is upside to this, I think it's really good risk to reward. So we'll see how it goes. We've got some nice momentum trying to start here. I'd love to see some breakouts to start really confirming this idea, but I'll look to trade long and see if I can catch a bigger upscale rally. Next up is commodities. We'll take a look at gold and silver here. So gold, I have a target of 3,000, and silver, I have a target of 33. So if we take a look at gold, you may at first say, well, 3,000 seems really far away, right? And if we take a look at the daily chart, I think the reasoning for this is that we have very nice overall long-term momentum. Now, if you take a look at the recent kind of pullback that we've seen, moving averages kind of furling over here, there's some short-term sideways price action. But I still think that there are a number of reasons to keep gold on the bullish side going into the new year on a longer term basis. First of all, over the long term, gold just inevitably goes up. They print more dollars every day. Gold should continue to go up over time. Now, there are times where it goes up quickly, and there are times where it goes up slowly, and there's also times where it goes nowhere for a decade. That is also possible, but in my personal view, the most likely path for gold is up. There's a lot of central banks looking to cut rates, including the US. Inflation overall in the global situation has cooled, which has been a very big help to gold in 2024. And I think that's most likely going to continue. The other thing that is kind of a constant in our world, it seems like right now, is uncertainty geopolitically, right? Stuff going on in the Middle East, going on in Taiwan and China, things going on, with Russia and Ukraine. There's always that little uncertainty window in the background. And I think that continues to support gold prices. What I'd love to see in order to get us on path to that 3,000 target by end of 2025 would be breakouts of these key levels of resistance that we've been stuck in recently. Now, of course, in a year from now, when we're going back and looking at this video, this will all probably just be looking like old noise. Again, the bigger move here to me would be a break through this 2,800 is making 3,000 seem way more likely. But still remember that a move to 3,000 still gives us a good bit of an upside. That's a 15% upside move in the gold market. So I still like the Russell, I still like gold, I still like the NASDAQ. Those are kind of areas that I'm leaning into. And the other thing about gold here is that gold offers a little bit of a diversification to traditional stocks in my portfolio. So I do like the idea of keeping an eye on gold on the long side in case we do see a big reversal of the stock market rally we've seen. Silver's been a big hit and a miss here. We actually lost the 200-day moving average. So my target of 33 is much less, I guess aggressive as gold. This is about a 15% upside move as well, but you have to remember silver moves much quicker than gold. So, if I was really bullish on on silver, then I would expect something like 37, like 38, like big upside move. I just don't quite see that right now. That being said, if the Chinese call that I have actually works out, and I don't have call options, but rather the opinion that I have of Chinese stocks potentially moving higher, that actually could act to save this bear move that we've seen and turn it back bullish for silver, because again, silver is a commodity that is used heavily in industrial manufacturing, things like that. It's like solar panels and all sorts of stuff. So I do like silver on a long-term basis, pretty much always on the long side. But right now, price action looks really rough. And I think that until we sort of recapture some of these moving averages and key levels, I'm not going to get overly bullish. Next up, we'll talk about oil, specifically WTI USD. I actually think that oil could continue its downward trend that we've seen in recent months. And although the overall picture for oil here recently has been a little bit stronger, I don't love the idea of massive upside moves in oil next year, simply because of fiscal policy on Donald Trump's side of things. He wants to severely pump more oil to help keep inflation under control and reduce taxes across the board. So if that happens, right, the best way to keep oil down is, again, the U.S. becoming a major exporter and massively increasing the supply of oil, which I do think could bring us pretty handily down on the price of oil. In fact, that actually, in terms of a percentage move, a move from where we currently sit down to 60 is a 17% drop. I think that's honestly a little bit aggressive, but I would not be surprised to see if you get major pumping from the US, oil prices could really fall, and some of the OPEC nations might kind of, like a house of cards, might have to fall apart there, because again, if they want to sell oil, the OPEC nations, which are major exporters of oil throughout, think like Saudi Arabia and countries like that, they band together to limit the supply that goes out into the global market to keep oil prices higher. But if the U.S. joins the kind of parade there and produces a bunch of oil, those other countries might struggle and be forced to sell at lower prices too. That being said, I'm actually short-term bullish on oil, surprisingly, just because technicals are looking pretty strong and the U.S. economic numbers have been really upbeat. So if that is the case, I may actually see short-term upside for oil. I'm not incredibly, convinced I'm going to keep my target as low as 60 for next year, especially if perhaps we see a little bit of a breakout here in the short term, as energy demands are still very high overall. So, one of those things, if we get a geopolitical thing, if you get a war, that's why oil is a very difficult market. Oil could be up to $85 a barrel or down to $55 next year because of the uncertain things that can come out of nowhere, like a big war. Like nobody saw Russia and Ukraine going at it in 2022. And if we take a look at what happened to oil prices then, you can see just how crazy the moves actually were for oil prices. From the lows of 2021 to the highs of 2022, oil prices doubled. Let's talk currencies here quickly. If we take a look at the dollar index, I see a little bit of upside for the dollar index personally, though some of the other analysts here at A1 have mixed opinions, so we actually have a team kind of bias that's pretty neutral on the dollar. The dollar index on a technical basis looks really strong. It's really broken out here towards the end of 2024. And so far, going into 2025, I think I have to remain kind of tentatively bullish on the dollar for now. That being said, I don't think that the U.S. kind of economic outperformance is a forever thing. Other countries will, it's not, U.S. economy and everything else. They do have impact on one another. So if there's drag in other places, we may see the dollar kind of lose that steam at some point. So I do see upside for the dollar, maybe a 110 target, which is not that far. That being said, if the labor market at all cools next year or the trade war stuff causes some concerns, we could see very quick drops in the dollar index. In fact, this whole trend could get reversed if you see some sort of major trade war concerns, just something to think about as well. My target for the euro is 1.015, which is a move all the way down to this point here. I don't think that is completely out of the question. Again, I do think that the dollar is a little bit overbought right now. That being said, even if we get a bit of a bounce, I still think that next year you most likely see the euro against the dollar continue lower. That's at least my perspective at this time, given what I have in front of me for US economic data being so strong, at least at the end of 2024. Same thing with the pound. I see a little bit more pressure to the downside there. 1.19 is a move of, let's actually put that in pip form. That would be around 4.8% move or a 600 pip move overall. I would not be surprised if we do, see some bounces in the meantime, perhaps even, short-term uptrends, but I do still think most likely path for the pound dollar is lower given the very strong U.S. economic data. And taking a look at the dollar yen, Given a generally speaking decent global economy at this time, I think that the yen will continue to be a bit of a borrow currency. Basically, lots of different carry trade vehicles short the yen or borrow yen in order to buy other currencies, other bonds, and other stocks in other countries. So I do actually think the overall path for the dollar yen, given the current perspective, is a move back up towards 162 next year. And again, if the dollar does have some corrections or pullbacks in between, we may still see, kind of larger scale pullbacks in between that point and now. Getting into some more speculative and for fun stuff. I guess it's not really completely for fun. I actually really like trading Bitcoin. I made a lot of money in 2024 trading Bitcoin. My target for Bitcoin is 125,000. At the time that I put this forecast out, Bitcoin was only down at 90,000. We have quickly made a move up to 108 and have since come back down pretty close to 90,000, like 93, 94 at the time of recording this. So going into 2025, I do have a long position on Bitcoin. We'll see if this play works out. I mean, this is one of many trades I intend to take. If this takes out the lows, I'll of course stop out. But what I'm looking for in terms of a 125,000 target price on the price of Bitcoin is, Bitcoin is moving with a ton of momentum. That could fail out and completely reverse. I mean, this thing could be down 50, 40,000 by the end of 2025. This thing is incredibly volatile. But as long as the overall story, inflation falling, interest rates coming down, economy looking decent, employment holding up, as long as we continue to see that soft landing scenario, Bitcoin is one of my favorite picks for 2025. And where we currently trade at the time of recording this, that gives us an upside move of about 31 to 32% on the price of Bitcoin, if I'm correct. And that's a big if, because we'll see. Ethereum, I have a price target of 5,000. Which in a percentage form actually looks kind of crazy. That's a 50% upside move, give or take, from where we currently trade, which has had a big pullback here, about a 22, 23% pullback. I do think that, if Bitcoin continues to roar, the altcoin stuff could continue. I do think that, once you get into the altcoin season full blown, you're probably nearing a top in terms of markets. That's been a pretty decent indicator if we go look back at 2021. But right now, I don't think that we're in full-blown alt season, quote unquote. And I do think that Ethereum actually has a lot of practical use cases in terms of the technology. It's pretty cool. Dogecoin, this is a complete meme and a joke, but if we do see altcoin season fully erupt, I think that we could see that $1 target, which is a 211% upside. Again, I actually don't own any Dogecoin, and this is mostly a for fun prediction. But, I do think that this was just meant to be an indication that I think that altcoin season, quote unquote, I'm not a big crypto person. Let me be fair. I trade these things. I'm not like a hodler or like super long-term believer per se. I mean, I think that there's potential for these things to be in the future, but I'm not, here to completely predict what the paradigm shift for the next 100 years is going to be. I don't know, right? But the big picture here is I do think that altcoin season could take place in 2025. Right, I think that you've had a lot of hospitable stuff forming in the markets. Stocks are going to rip, in my personal view, right? I could be dead wrong about that, but I think that stocks are going to do well. And so with that, I think off the back of that, you get even more potential upside in the higher risk stuff. That's generally what happens is if you get a really good move in the stock market, the very high risk stuff goes absolutely parabolic. So I'm staying pretty consistent across the board here, or at least trying to be. My opinion is that we could see upside for crypto, and that, if I'm right about these ideas, could mean altcoin season stuff could really take place in 2025. I do want to just pause, as I just mentioned, probably the most aggressive, kind of opinion that I could have in this video. Let me just mention that all of these ideas are not something that I'm riding off of a cliff. If we see a major turnaround story in markets and things get really ugly in 2025, I use stop losses on trades. I have hedging positions in many things that I hold long term. I use a lot of cash in my portfolio on the sides to stay liquid so I can prepare for dips. I just want to put that out there because I'm not going all in on these things. These are things that I'm generally, forecasting a general direction for, but I could be completely wrong. That being said, that is the importance of risk management and, kind of dealing with trades that go wrong if you have them so that you don't get crushed if you do truly see a major market crash next year. Last on the list is treasuries. I actually think that the US 10-year is most likely unless we have a big spike in inflation, I don't see it really moving too far in either direction. That being said, recently they have been trending up. Yields, of course, are bonds, bond yields, right, from US Treasuries. And if this thing is going up, usually it means the bond market thinks there's going to be more inflation or less rate cuts. And right now, you know, that's kind of been a story forming, but my general perspective is I think that yields may shoot around, but overall I don't see them going too far up or too far down next year. I think the US economy is relatively strong, which kind of caps the downside, but I also don't see inflation going absolutely parabolic because we don't really have any sort of threats to supply lines at this time. Now, if you get a big war outbreak, this thing's probably going higher. Basically, if there's a big supply disruption like we had during COVID and during the Russia-Ukraine stuff, you know, that could lead into some serious inflation, which could really dramatically make things uglier. You can see in 2022 with all the inflation that came about through the oil stuff, that really put a dark side to markets. So if you get a huge uptick in inflation once more, then we have problems across pretty much everything I've mentioned in this video, and I will quickly adjust. If I see signs of inflation roaring or major inflationary events happening, I will probably take a big reversal in a lot of the opinions that I have in this video, and I'll do so with humility because honestly, the thing about trading is you've got to admit when you're wrong sometimes. So I'm looking for inflation in 2025 as the number one thing that makes me concerned about what could actually make markets look ugly, go from looking really good to really bad really quick. As a bit of a bonus round, we'll take a look at just some sectors that I like for 2025, which include, for starters, utilities, which I think are pulling back here reasonably and may actually be a good pickup for the new year. Part of the reason here for this is that utilities are of course part of the grid system, power companies, things like that. And I do think that the demand for power, which is already very high in the United States, will continue to rise. And if you do get rate cuts this year, that should continue to boost the kind of price action here that we see in utility stocks. I'm using XLU as my proxy here. I also do like financials as well. And this is a sector that's already performing very well, especially off the back of the Trump victory, right? The idea that he may bring back a lot more or a lot less regulation, which could be very good for mergers and acquisitions, and a lot of the IPO market stuff could come back. And of course, financial companies could stand to gain, especially the capital market side of things. I also like real estate, which I think is trading at a decent pullback here to the 200-day moving average going into 2025. And of course, I still like technology. Technology is where a lot of the growth is at in the US stock market. And so I'll stick with this trade as long as it continues to work. Technology was a killer in 2024 and in 2023, and I am not expecting it to really fall apart this year, at least at this current time. I hope this video has been helpful to you, and please, as I mentioned earlier in this video, do not take this as financial advice. Do not take me as always right. I showed you at the beginning of this video several things that I got wrong about 2024, and there is a almost certain probability that I will be wrong about some things in 2025. So with that said, I hope you enjoyed this video. Remember, if you want access to our tools, the A1 Edge Finder is currently available down below in the description. If you're looking for new brokerages or you'd like to keep up with us on Telegram, there's a ton of free value down below in the description. We have sign-up perks for brokerages. You can join our Telegram channel for free, all sorts of good stuff. Just head down to the description and take advantage of some of those free things. Thanks for watching and have a great 2025. If you're looking for a better brokerage, then stick around for a second. I'm going to tell you how you can get some free sign-up perks with great brokerages all around the world. Whether you trade FX or indices, commodities, futures, all of the above, I'm going to show you a really cool way that you can get free sign-up perks with your new account. So if you're interested in switching into a different brokerage, you can get things like deposit bonuses or free stock shares, or you can even get access to some of our products for completely free. All you have to do to find out current perks being offered to new depositors is go to a1trading.com/brokers. That's a1trading.com/brokers. And as you look at that page, you'll see all these different offerings that we've currently locked down for you guys as subscribers, as viewers. Now, of course, we get something out of this. If you choose to use these links, you'll be supporting our page. But in return for the viewers, we've got great sign-up perks available for you guys so that you get some free game just by signing up for a brokerage if you're looking to do so. So check it out on our website. You can find current deals at a1trading.com/brokers. forex.com/brokers. Thanks for watching this video, and on the screen right now, you'll see some other options of other videos we put together that might be helpful to you in your trading career. So thanks for watching, and we'll see you next time.